Did you know you can learn to speak basic insurance terminology in just 5 minutes or less? When you're starting out in the insurance industry, all of the various terms can be overwhelming, but they don't have to be if you just start with the basics. Insurance. Insurance is an economic device used to transfer risk from the individual to a company, thereby reducing the uncertainty of risk of loss via pooling of funds. Insurance is a tool for risk managers. Indemnification. The principle of insurance is indemnification. The basis of insurance is that the policy holder who sustained a loss should be restored to the same position they were in prior to the loss. Indemnification, also known as being made whole. Remember, insurance protects against the risk of loss. Risk. That's the uncertainty of the possibility of loss for which insurance is purchased. Pure risk are circumstances including the possibility of loss or the possibility of no loss, but no possibility for gain. Remember, pure risk is not gambling. There's no possibility for profit. Insurance covers harm to an insured's financial well-being. The name for what triggers coverage or what the coverage is meant or what the insurance is meant to cover can vary. A loss by any other name. Exposure, the risk of possible loss. Peril, the cause of loss. Loss, physical damage or bodily injury, including loss of use or loss of income. Accident, an unexpected event or circumstances without deliberate intent. Occurrence is an accident, including injurious exposure to conditions which results in property damage or bodily injury neither expected nor intended by the insured. Proximate cause, the risk covered under the policy that sets the events causing the loss into motion, just like dominoes. Now, not only is there risk of loss, there is the probability of loss, also known as hazards. A hazard is a circumstance that tends to increase the probability or severity of a loss. Moral hazard is a personality characteristic that increases the probability of a loss. You know, people setting fire to their house because they want the money, insurance fraud. Moral hazard, that's moral hazard. Morale hazard is when a person's characteristic makes them negligent or lazy when it comes to taking proper precautions, such as taking care of the brakes on your car. That can lead to an accident. Negligence. That's failure to exercise reasonable care, resulting in property damage or injury to another. Show me the money. Speaking of money, let's talk about some of the financial terms related to insurance. Premium, money charged for insurance coverage. Deductible, the dollar amount of the loss paid by the insured. Rate, the value of an insured loss expressed as a cost per unit of insurance. Reserve, a portion of the premium that's retained to pay future losses. Think of it as budgeting to pay your bills. Coinsurance, a clause in most property insurance policies to encourage an insured to carry a reasonable amount of insurance. If the insured fails to carry the amount specified, they must pay for a larger portion of the loss. The goal is to promote adequate coverage. Copay, the set amount you pay on a medical bill that the insurance doesn't, similar to a deductible. Depreciation, reduction of the value due to wear and tear. Actual cash value, also known as ACV. It's replacement cost minus depreciation. Replacement cost, the cost to replace the property without deduction for depreciation for ordinary wear and tear. ACV, depreciation. Replacement cost, no depreciation. Aggregate is the maximum dollar amount or total amount of coverage payable for a single loss or multiple losses during a policy period or a single project. It can be less than the amount of the policy limit. And limit, that's the maximum amount owed under the policy. Now, let's dissect that insurance policy and talk about its various parts. Declaration, that's the policy statement about the insurance applicant and the property covered. Effective date, the date coverage starts. Expiration date, the date coverage ends. Endorsement is an amendment to the policy adjusting the coverage that takes precedence over the general policy. Exclusion, a provision in the policy that eliminates coverage for certain events, property, or locations. An endorsement can add coverage, and exclusion can subtract coverage. And last, the named insured, the person covered under the policy. So, they tell you it's who you know in the biz, right? So let's talk about the various people that you may do business with in the insurance industry. Assigned risk pool. An assigned risk pool is a government pool designed to write coverage for people or businesses that cannot find coverage under the standard insurance market. It's also known as the market of last resort. Captive agent. That's an agent who sells insurance for one or a specific number or a specific group of insurers only. An independent agent is an agent who can sell insurance and services for multiple insurance companies. A broker is a person who places insurance business with an insurance company. But unlike an agent, the broker is usually considered to represent the buyer or the insured and not the insurance company. Agents work for the company. Brokers work for you. And producer. A producer is a person who sells, services, or negotiates insurance coverage. They can be an agent, they can be the broker, or they can be the underwriter. An assortment of words used in the insurance biz. Lapse, termination of coverage for failure to pay your premium. Subrogation, the right of the insurance company to pursue reimbursement for losses they paid to or on behalf of the insured due to accidents caused by a third party. Retention, the amount of loss or risk that the insured feels comfortable paying before insurance kicks in. It can also be your deductible or your copayment. Appraisal, it's an estimated value. Hard market is when there is very little coverage with a high demand for that coverage that's in limited supply. Soft market is when there's an abundant amount of insurance coverage that drives down the premium costs. Guarantee fund. That is a fund that's provided by the state to cover losses of insolvent insurers. And surplus, retained earnings. So, now that you know the basics, you can speak insurance with confidence. Thank you.